Financial analysis of Charles Schwab, researched by Grant Jones. History. Charles Schwab and Company was founded by Charles, also known as Chuck Schwab, in 1975, with the first branch located in Sacramento, California. Charles Schwab was acquired by Bank of America in 1984 for $55 million. By 1985, Charles Schwab recorded 1.2 million clients with $7.6 billion in client assets under management. Chuck Schwab bought back the company from Bank of America for $280 million and filed for initial public offering on the New York Stock Exchange in 1987. In 1995, Schwab launched the first online trading platform, Schwab.com. The Schwab Corporation was added to the S&P 500 in 1997. By the end of 2012, Schwab's client assets under management had grown to $2 trillion. In 2019, Schwab acquired USAA's asset management assets and partnered with TD Ameritrade in 2020. Financial performance. Charles Schwab saw an average 27% net income growth during the fiscal years of 2017 to 2019, before experiencing almost an 11% decrease in net income growth from 2019 to 2020. Schwab still recorded a positive net income of $3.3 billion, proving their versatility during the challenging COVID-19 economy. Charles Schwab accounts for the underperforming year due to the challenges faced during the COVID-19 pandemic. The decision by the Federal Reserve to lower federal interest rates, market volatility due to the COVID-related closures, the switch to remote operations hindering operational efficiency, and the decrease in client investment and increase in client cash balances resulted in less excess capital for Schwab to return to stockholders, has resulted in their financial challenges in 2020. Stock analysis. Despite the underperforming reported net income growth, Schwab stock has seen a consistent growth from the $53.22 on January 4th of 2021 to a current closing price of $70.55 on July 9th of 2021. Currently, Schwab is reporting an allocation of 72 cents per share, or less than 1% dividend yield. Interest rate revenue accounts for 50% of the company's earnings, which could see a significant increase in the future for Schwab's $300 billion of banking deposits if the Fed increases financial interest rates. Schwab's trading revenue accounts for 20% of the earnings, despite making 0% commissions on individual tradings. Their trading revenue stems from other forms of trading charges and management fees. Their 0% commission limits the earning potential for the trading platform, but also helps cross-pollinate their lending business through the practice of lending on securities and increased client asset investment. Schwab does not make the earnings from their experienced self-traders, but benefits from high-worth individuals that invest their capital with Schwab and utilize their lending services. Schwab is able to create 30% of the revenue from asset management and administration fees. They charge for offerings such as investment management services offerings, exchange-traded funds, separately managed accounts, and robo-advisor offerings. The merger with TD Ameritrade has made Schwab one of the largest comparable financial institutions with $6 trillion in client assets. Despite the positive upside, the merger could potentially create a profit tailwind over the next 18 to 36 months as the company works through TD Ameritrade's expense and profit synergies with Schwab. Investment decision. Schwab's scalable and vertically integrated business model will allow them to convert an increasing future percentage of revenue and earnings as they evolve themselves within the investment management industry. I see Schwab as a safe investment with a 1% dividend yield. I do not think it is an ideal time to invest in Schwab for a high-yield, risk-seeking investor, but I can see the benefit for a risk-averse investor interested in a long-term investment in a blue-chip stock. This is not a growth or value stock. In fact, financial analysts consider Schwab's stock price to be overvalued as of right now. Risk-averse investments are appealing during the current volatility of the stock market and uncertainty of the future effect of the increasingly high 4% US inflation rates. Schwab has a high economic moat, allowing them to differentiate themselves from competitors such as Morgan Stanley, Raymond James, and LPL Financial Holdings. A main concern for the future profitability of Schwab will be if the Fed extends the longevity of the 0% interest rates, or if the stock market falls into a bear market, limiting client investments. Thank you, and the resources utilized during this presentation will be included within the works cited section of the research paper.